Here. So typically I like to give some notice before I do these member-only live streams, but I have my opportunity to come out and do this now, and I'm going to read through dollar funding stresses in China. This was given by the Federal Reserve Bank of Boston, November 1st of 2022. Pretty interesting little read talking about the dollar funding and stresses. And really, it's talking about the dollar denominated debt outside of the United States. And this is a really interesting topic to cover. Most people just kind of focus in here on the United States and the things that are happening here, but very few people actually look outside of the United States to see how much demand for dollars truly exists out there. So I'm going to read through this paper. I'm going to try and go for no more than an hour. I'm not sure how far we're actually going to get into this, if we can complete the entire thing. It is quite extensive. There is a lot here, and I'm not exactly sure of all the technicals that are talked about in here, because they get pretty descriptive as far as some of the things that are taking place. But I think the bulk of the information is really just about how much dollar demand there is outside of the United States. And this really does a great job of describing it. So let's go ahead and dive into it. So, dollar funding stresses in China, October 23rd, 2022. November 1st, 2022. I guess this is kind of like a working paper or something. All right. The need for U.S. dollar funding during the financial stresses in mid-March of 2020, as the COVID pandemic news shocked markets, was evident in a number of countries. Notably, however, China's dollar liquidity needs received little attention. Given China's significant economic and financial linkages to the United States and the rest of the world, financial instability there could have implications for the global economy. Hence, it is useful to develop a deeper understanding of the dollar liquidity needs of Chinese banks and non-financial corporations, and to probe whether existing avenues of dollar funding for banks other firms in China are sufficient in times of stress. This is our objective. Now, this is pretty interesting when they start going into this. Now, I perused this a little bit. I've read through quite a bit of it, but I haven't read it like really deeply. And it really gets pretty good here when you start to think about some of the issues that are going to be taking place if this quantitative tightening continues. But this is talking about like the issues that had happened during COVID, or during the COVID pandemic. Dollar funding stresses abroad are instantly observable through the cross-currency basis, the CCB, between the dollar and foreign currencies. For any given currency, this basis is the difference between the interest rates for borrowing dollars directly and the interest rates for borrowing dollars synthetically by combining a foreign currency borrowing with foreign exchange derivatives. Now, I know that's kind of difficult to understand, but it's basically describing the demand for dollars is, I'm assuming, for inside of that by the interest rates that are paid out on these things. Okay. If funding markets are efficient, arbitrage between these two alternative methods for borrowing dollars keeps the basis near zero. When access to the dollar funding is stressed, however, the magnitude of a cross-currency basis relative to the dollar can become significantly negative because of the balance sheet constraints of potential arbitrager banks. For example, in mid-March of 2020, the basis between the US dollar and the Korean won became quite negative. Korean banks that had difficulty obtaining dollar funding resorted to borrowing won and converting their won loans into dollar funding with FX derivatives. They were willing to pay synthetic dollar funding costs far above dollar borrowing rates available to the global banks with more direct access to dollar funding. The magnitude of the USD KRW basis was reduced when the Bank of Korea held its first US dollar auction at the end of March, following the establishment by the Federal Reserve of a temporary dollar liquidity swap line with the Bank of Korea in mid-March. The Bank of Korea then conducted regular dollar auctions that allowed commercial banks in Korea to source dollar funding at considerably low interest rates than otherwise available on the wholesale market. though the Bank of Korea's dollar funding rates were still above typical prevailing market rates in non-stressed conditions. This facility expired as of December 31st, 2021. The USD CNY and the USD CNH basis also became quite negative in March of 2020, as shown in the figure 1, tripling in magnitude to about 110 basis points. The CNY refers to renminbi deposits in onshore Chinese banks, while the CNH refers to renminbi deposits in Hong Kong banks. Compared with a set of advanced economies in emerging market countries whose banks also had large U.S. dollar debt exposures. China was among countries with the largest negative cross-currency basis in March of 2020. The basis for USD CNY and USD CNH in March of 2020 were more than 4 standard deviations below their 2019 means, lower than that of any other major foreign currency as shown in figure 2. This is clear evidence that the Chinese banks had significant difficulty obtaining dollar funding at interest rates prevalent in, quote, normal times. Evidently, China was not an exception with respect to widening of cross-currency bases in many dollar-dependent markets. Most notably, Japan and the euro area experienced the same stresses. As financial market conditions improved alongside the rapid policy responses by the central banks around the world, the difficulty of obtaining dollar funding subsided, and cross-currency basis between the U.S. dollar and currencies of some countries with access to dollar swap lines not only reverted to pre-March levels, but even turned positive, suggesting that countries with adequate sources of dollars became dollar providers. This could have benefited countries such as China that had no dollar swap lines, and is consistent with the fact that the USD CNY and the USD CNH bases did eventually recover, albeit more slowly than more slowly than some other cross-currency bases. The cross-currency basis is the only available indicators of market stress in dollar funding markets. We next review how dollar borrowing has grown in Chinese financials and non-financial sector. All right, you guys following along with this now? I know it's a little bit difficult with some of these like cross-currency stuffs, and it's like, hard to like wrap your head around, but ultimately what was going down is that they had issues with trying to find the dollar fundings, right? And now some countries have dollar funding, like they have direct lines that they can access it, and those countries end up being the providers of dollars, is what they were saying. And these financial and non-financial, what does it say? The review, and now the borrowing has gone on with these financials and non-financial banks. Okay, let me see if I can get to some of the good stuff here that really starts making sense. All right, the extent of the Chinese dollar-denominated debt. Here we go. Heavy global reliance on dollar-denominated debt has been a phenomenon for some time. Non-U.S. banks commonly issue short-term dollar liabilities. Now, think about that for just a minute, right? Non-U.S. banks commonly issue short-term dollar liabilities. Nothing to do with the United States. And did so even before the run-up to the global financial crisis. Many non-financial firms in foreign countries also finance some of their activities in dollars. The dollar liabilities of non-U.S. banks have now surpassed their 2007 levels, as shown in Figure 3, reproduced by the IMF in 2019. And there's links to this all down in the description if you want to go and look at the charts. Okay. And the IMF, pointed to the increased extent of dollar borrowing by foreign entities, including non-U.S. banks, non-bank financial institutions, and operating companies. The outstanding quantity of dollar-denominated international debt securities and cross-border loans is 26% of the global GDP and is 50% of outstanding debt securities in all currencies. You guys get that? How much dollar-denominated debt exists out there? All right. Factors that support global reliance on dollar funding included good Lord, between dollar trade invoicing and the dollar as a safe haven. So again, factors that supported the global reliance on the dollar funding included the dollar trading invoices and the dollar as a safe haven. So people wanted to use the dollar to do the world trade. That's what they mean by dollar invoicing, right? And as a safe haven, meaning like they don't know where else to go with their money, so they go to the U.S. dollar as the safe haven asset. A preference among global investors for dollar-denominated fixed income assets, and an independent central bank of the Federal Reserve. All right. So Chinese dollar-denominated debt is primarily issued by its banks, corporations, and local government financing vehicles, otherwise known as LGFVs. The latter two categories are often lumped together, so the corporations and those local government financial vehicles, and referred to those as CGFSs. All right. Before providing a rough sense of the magnitude of the dollar borrowing by Chinese entities, we emphasize the incompleteness of the available data. For example, currency denomination of debt issued by Chinese entities is often not reported or is reported inconsistently. Maturity information is typically difficult to find. The dollar exposure of Chinese banks. The Chinese banking system is the largest in the world, with the total assets in Q1 of 2021 of about 330 trillion RMB, or about 325% of GDP, which is also high by global standards. Although much of the domestic activities of Chinese banks are denominated in renminbi, the largest banks are highly active abroad and rely most heavily on the U.S. dollar for their foreign borrowing and lending. Banks dominate the Chinese financial system, holding over 2/3 of its assets. They are highly interconnected with other parts of the Chinese financial system and the real economy. According to the public, I mean, this is where a lot of people really kind of like, I think this is what's important about it. I'm just going to take a quick break here for just a second, but I think this is really important to understand that how much demand for dollars China really is looking for, and how like intertwined they are with the dollar. Like a lot of times you will hear like the whole BRICS thing, or how people are getting out of the dollar, or these nations are abandoning the dollar. You really have to like take a lot of this stuff into consideration, and that the amount of demand for the dollar inside of the debt market is just absolutely immense, right? According to the publicly available Bureau of International Settlements banking data, as of Q3 2021, international activity reporting banks in China, which include a small proportion of the non-Chinese banks with affiliates in China, have cross-border liabilities amounting to 1,563 billion, which I guess is what, 1.5 trillion, of which 586 billion, or 37%, is dollar denominated. So let me read that again. According to the publicly available BIS banking data, as of Q3 of 2021, international activity reporting banks in China, this is the international activity reporting banks in China, have cross-border liabilities amounting to 1,563 billion, of which 586 billion, or 37%, is dollar denominated. So like over a third of it, 37%. However, these same banks have 1,057 billion in cross-border dollar assets, dollar-denominated assets, implying a large dollar funding gap. The BIS data cover total cross-border assets and liabilities in a given currency without a sub-breakdown for maturity. According to the public BIS data, the on-balance sheet dollar funding gap of 471 billion represents about 20% of China's total external debt. So huge amounts of it, right? And like I couldn't tell you like how significant that number is, but to me that seems like quite a bit. All right. Typically, a dollar funding gap is associated with the reliance on short-term dollar liabilities to fund long-term dollar assets, representing a potential source of financial instability. China's bank supervisors monitor mismatches between assets and liabilities in foreign currencies. Chinese banks likely cover some of their large dollar funding gap with derivatives such as currency forwards and swaps. The total of direct dollar liabilities and synthetic dollar liabilities achieved in derivatives markets represents a significant rollover risk that becomes apparent during stress periods through an elevated cross-currency basis as occurred in March 2022. So when you think about like the rolling over of old debt into new debt, when the interest rates rise, they just can't simply afford the new stuff, and so they can't roll over that old debt into new debt, and that's where the real like liquidity issues begin, as people are no longer able to make their payments. All right. So basically, like if you can't roll your old debt over into new debt, how do you get the funding that you need? You have to pay that old debt off without taking in any new funding. All right, comparing with funding gaps in other countries, publicly available BIS data suggests that the dollar funding gap for Chinese banks is relatively large, in line with those of Japanese and Canadian BIS reporting banks, and is increasing. Banks in countries with negative gaps, such as those of Australia, France, and the United Kingdom, as well as U.S. banks themselves, would in principle be able to provide dollar funding to Chinese banks. Figure 4 shows the dollar funding gaps by countries, relying on publicly available BIS data. However, data for most countries include local positions, domestic lending, and borrowing in U.S. dollars, whereas China does not report these domestic exposures to the BIS. Moreover, the publicly available BIS data do not include bilateral relationships among reporting entities on a national basis, including the extent to which the Chinese banks lend to each other in dollars within China, which could affect the overall reporting quantities for China. Based on confidential underlying data, the analysis of Eldessaro, Ehlers, and McGuire and Von Peter of 2022 show that a combined funding gap of the four largest Chinese banks moved from positive to negative from 2016 to 2018, which suggests they had more dollar liabilities than dollar assets, a situation that could be present even now. This piece of evidence, taken together with the publicly available BIS data, implies that these four banks could help to fund the large funding gaps of the other Chinese banks. It is possible, however, that the public BIS data provided an inaccurate portrayal of the net Chinese bank exposures, or both. I know a lot of this stuff is just like really hard to wrap your head around. And like I said, a lot of this stuff, I'm not even sure if I understand all the technicalities of it all. But again, like if you just kind of take this stuff in for just a minute to try and understand what it is that they're really trying to get to, I think the point of it is really starting to make itself clear here in just a minute. The BIS data security statistics cover debt issued by the Chinese banks in terms of both outstanding amounts and net flows. International debt outstanding issued by Chinese banks amounted to 80.8 billion out of the 229.6 billion total international debt outstanding as of QT 2021. Some 35% of the international debt outstanding, 63.5 billion, that represented some 35%. Okay. Of the international debt outstanding, 63.5 billion, 79% is dollar denominated. Of the total bank debt, the original maturity over 1 year of the amount outstanding was 93%. Without more maturity information, we are unable to deduce the exact extent of liquidity or rollover risk, but the dollar portions indicate that these risks could be large. The average maturity of bank debt tends to be relatively short in comparison with non-bank corporate debt. Chinese banks have dollar liquidity and credit exposures through their lending to borrowers in countries involved in the Belt and Road Initiative. Now, this is important to remember because, this is something that I have kind of suggested and think that is probably one of the positions, one of the strategies that the Chinese government knew to do in case the dollar started getting really strong, right? If the dollar started getting strong and the Chinese corporations and in the country itself was no longer able to access dollars, they needed a way to get dollars. And if they couldn't borrow them or they couldn't sell their products or something, they had to have some sort of way of acquiring dollars into their nation. And they have that Belt and Road Initiative. Now, listen to this. Chinese banks have a dollar liquidity and credit exposure through their lending to borrowers in countries involved in the Belt and Road Initiative, the BRI. So this Horn, Reinhardt, and Trebesh, I guess there's some economists there for the Fed, estimate that around 75% of BRI loans are denominated in US dollars and are provided by Chinese development banks and 4 largest commercial banks, which are predominantly state-owned. So you guys get that, when they lent all these countries money, they didn't lend it in yuan, they didn't lend it in renminbis, they didn't lend it in rupees, they lent it in dollars. 75% of it was done in dollars. All right. Updated aid data suggests that between 2000 and 2017, $1.6 trillion of dollar-denominated loans and grants, and this is in 2017 constant dollars, so not like inflated dollars. 1.6 trillion of dollar-denominated loans and grants were provided to BRI countries. So this is how much they were lending out. 90.6% of the total. The Chinese lenders typically require the borrower to deposit the loan proceeds in the lender's banks. Because of this, the balance sheets of these Chinese banks may not accurately reflect the associated net credit and liquidity exposures. However, since the 4 large commercial Chinese banks have more than enough liabilities to cover their assets, they appear to avoid the problems of needing to roll over their liabilities. These liabilities could potentially be in the form of stable dollar deposits since they are connected to the long-term infrastructure projects of their borrowers rather than a runnable short-term debt, right? So they put out all these loans out there for these long-term projects when it came to the Belt and Road Initiative, and now this is a constant flow of dollars coming back to them where they don't, what had they put it, these liabilities could potentially be in the form of stable dollar deposits since they are connected to the long-term infrastructure projects of their borrowers rather than a runnable short-term debt. Unfortunately, neither the maturity nor the credit composition of the liabilities is evident in the report, so they don't know exactly what it is, right? They're assuming at that point that this is all happening. On the other hand, the balance sheet of one of the largest foreign currency lenders, the China Development Bank, a government-owned entity, does appear to have a significant dollar net exposure amounting to $110 billion in 2020, according to its annual report. The takeaway is that the liquidity risk may be somewhat less for the 4 commercial BRI reporting banks, though it is impossible to precisely gauge the liquidity risk from the public data. There is also likely to be some credit risk associated with the currency risk facing the BRI borrowers. So that's pretty interesting to think, right? So a lot of these like Chinese banks who are like, how the hell are we going to get funding? How are we going to get these dollars? Well, there's so many of them exposed through that Belt and Road Initiative, lending out in dollars, almost guaranteeing them a source of dollar funding. Like being able to source out dollars through that Belt and Road Initiative that they had been doing since 2000, right? From 2000 to 2017. How far into this? 25 minutes. Cool. I think we're getting through this pretty well. Okay. The dollar exposures of Chinese non-financial firms. Okay. At the end of 2019, Chinese non-financial firms had 590 billion in outstanding US dollar denominated bonds, accounting for about 36% of all dollar bonds issued by emerging market economies. Wow. Right? That's a lot. I mean, considering. Let me read that again. At the end of 2019, Chinese non-financial firms, right? These aren't even like banks or anything else. These are like, I'm assuming like they're corporations and stuff, had 59 billion in outstanding US dollar denominated bonds, accounting for about 36% of all dollar bonds issued by emerging economies. 40% or 236 billion is attributed to bonds issued by Chinese property developers and the LGFVs. What was that? The local government. What did that stand for? I can't remember. It was local government financing vehicles. That's what LGFVs stand for. Okay. So 236 billion is attributed to bonds issued by Chinese property developers and the LGFVs, entities that have no natural dollar-based revenues. All right. So they got to like no not that's pretty interesting to think. They borrowed in dollars, but they have no real access to dollars, right? Entities that have no natural dollar-based revenues. This suggests a mismatch that would often need to be hedged in the FX derivatives markets or rolled over, meaning like the only way to get new dollars is to take your old debt and roll it over to a new one since you don't really have any funding of dollars. Okay, the 590 billion in outstanding offshore bond issues of Chinese corporations, including the LGFVs, accounted for approximately 29% of China's total external debt of the 2.1 trillion at the time. Wow. All right. So in 2020, it is estimated that between 2019 through 2024, a total of 488 billion of US dollar bonds issued by Chinese firms were to be extinguished or rolled over within new fundings. Wow, think about that, right? For just a minute. 488 billion of US dollar bonds issued by Chinese firms were to be extinguished or rolled over. So these higher interest rates are going to force these Chinese firms to roll over from old debt into new debt or just extinguish that debt altogether. Now, if it's extinguishing the debt altogether, that needs access to the dollars. If you're rolling it over, you need to sell that old or basically sell new debt at a higher interest rate, right? Meaning you're going to pay a higher interest rate in order to cover the bonds that you have already issued out, if I got that right. Among the most stressed of the associated borrowers are property developers who have been hit by regulatory leverage constraints. As of November of 2021, they were facing around 41.5 billion in US dollar liabilities maturing in 2022 alone, according to Bloomberg. Defaults on dollar-denominated debt in the fall of 2021 by Evergrande, the largest property developer in China, suggest that rollovers may be difficult if lenders observe further weakness in this sector, meaning that they're going to have a hell of a time getting that liquidity, right? If they can't roll it over like Evergrande failed to do. All right, in some non-financial Chinese corporates have a large portion of the outstanding dollar bonds issued internationally from emerging market countries. Non-financial Chinese corporates have a large portion of the outstanding dollar bonds issued internationally from emerging market countries. The dollar amounts of these bonds are large. Moreover, large portions of these bonds have relatively short maturities requiring rollover by 2024 and are obligations of entities that have no natural source of dollar income. You see, you hear what they're saying? Like they straight up say it. Like these countries, these people, these corporations have taken out dollar denominated debt. They have no real source of funding for dollars to pay that debt off, and then rolling that debt over into new debt. Here it needs to be done by 2024, and we're sitting in high interest rate environment. All right. So it's kind of like refinancing your house into higher interest rates or something. It doesn't make sense. It isn't going to work. All right. While the information that we have provided about dollar-based exposure to Chinese entities is far from complete, we believe that the available data imply that China has significant dollar exposure that could strain the ability of Chinese banks and corporations to source sufficient dollar funding during periods of stress. The Chinese US dollar exposures are growing. Right. So this issue is only getting bigger. It's not, again, I understand that this is about a year and a half old, but these trends are heading in a particular direction. You have to follow like a lot of the stuff that's happening out there that's not necessarily what's in your face, like the BRICS nations. Like that stuff is in your face. This stuff isn't. Right. People talk about it, but not in a serious manner, right? They talk more about like how it is that the dollar is going to fail and nobody wants it, but yet they don't really talk about the actual demand for dollars that exist in contracts that are out there. All right. China's US dollar exposures are growing. Although we are unable to obtain an all-in picture of dollar funding exposures in China, given the incomplete available information, the trend towards greater U.S. dollar borrowing and lending by Chinese entities is unmistakable. However, this increase in dollar exposure has been faster in China than in the rest of the world. China is special in the way, partially because of the faster growth and demand for credit by Chinese firms relative to the rest of the world, and partly because of the expansion of the Belt and Road Initiative, under which lending in dollars is preferred by both Chinese lenders and by the BRI borrowers. Further evidence of Chinese growing use of dollar funding is the expanding reliance of Chinese entities on foreign exchange swaps. The increased use of derivatives, and especially foreign exchange swaps, which underlie the cross-currency basis, is evident from the data on derivatives turnover in the BIS triennial surveys, which they show the graph down below. The figure 5 shows increases net notional volumes of trade of the FX swap by entities in China. So anyway, they just show this little graph of the turnover. Like, here, I'll just show it to you real quick. You can see the major increases that are happening there. And that's the swap turnover by entities in China. All right, dollar funding stresses in China could spill over to the rest of the world through several channels. Now, this is where like the contagion thing starts to get described, right? Okay, a lack of funding in U.S. dollars for Chinese non-financial corporates and financial intermediaries could result in difficulties in the ability of these firms to roll over dollar-denominated debt, potentially causing them to default to their lenders, which include U.S. banks and banks to which U.S. banks have exposure. Think about it, hear it again, right? The lack of funding in U.S. dollars for Chinese non-financial corporates and financial intermediaries could result in difficulties in the ability of these firms to roll over dollar-denominated debt, potentially causing them to default to their lenders, which include U.S. banks and banks to which U.S. banks have exposure. In turn, defaults or distress of Chinese non-financial corporates or financial sector firms could lead to concerns that other similar positioned institutions, both in China and in other countries with dollar exposures, would also default. Right? They're talking about it right here. This is the Fed saying this. Like, things happening in China creating these contagion issues could start spilling all the way over into U.S. banks, which would also default. Right? That's exactly what they said. All right. A recent example is contagion risk from the debt troubles of China Evergrande, a large Chinese real estate developer. Such financial disruptions can and have caused dollar-denominated corporate credit spreads to widen, affecting other asset classes, including those of U.S.-based high-yield debt. For instance, the rising default risk of Evergrande induced significant widenings of bond spreads in connected countries in Asia and in the U.S. high-yield bond market. Aside from detrimental effects on the cost of debt financing, dollar funding stresses in China could induce fire sales of dollar-denominated assets such as U.S. treasuries and a contraction in the quantity of credit in some countries in which Chinese banks are active lenders. These financial stresses could trigger or exacerbate a regional or global recession. Among other knock-on impacts to the economies of many connected countries, surges in sales of U.S. treasuries can also cause dysfunctionality in the secondary market for treasuries, as occurred in March through April of 2020, after the World Health Organization declared COVID to be a global pandemic. So describe it right there, right? That the contagion effect coming from Evergrande can then start spilling into the idea that they are in desperate need of dollars, and the fastest way to dollars is to start selling off U.S. treasuries, right? And that's where he says the fire sale could. Let me go. Okay. Aside from detrimental effects on the cost of debt financing, dollar funding stresses, right? So all of a sudden there's no dollars in China. The dollar funding stresses in China could induce fire sales of dollar-denominated assets, such as U.S. treasuries, and a contraction in the quantity of credit in some countries in which China's banks are active lenders. But I think that's the important part, is that it creates that fire sale of dollar-denominated assets, and the fastest way to get dollars is through U.S. treasuries and the selling of those. And see, this is another, like, when you hear about, like, all these countries like getting out of the U.S. treasuries, dumping U.S. treasuries, they're not dumping treasuries. They'd rather have the treasuries. That's the safe and liquid asset. What they're actually looking for is dollars, because they're in dollar funding stresses. All right, China's direct financial linkages with the rest of the world have increased in recent years. Even though they are more limited than what would be implied by the size of its economy, in large part due to its gradual approach to a loosening of capital controls among the advanced economies, Japan and the European Union have the greatest financial exposure to China. Direct linkages between China and the United States have been growing, as mutual fund exposures to China have increased through both equity and debt. With such increased investors' exposure to Chinese financial markets, investors in global bond and equity mutual funds could experience a relative rapid decline in their wealth after a fall in Chinese debt and equity prices. Another link in the opposite direction is the significant amount of U.S. treasuries held in Chinese foreign exchange reserves. Right? I mean, this is how much, like, to try and understand this, like, I know we're just kind of blasting through a lot of this information, but to try and understand, like, how intertwined this really is. And, like, people were like, oh, let them fail or whatever. You don't really want that to happen, right? I mean, you say you do, but then when the outcome actually comes from a fire sale of U.S. treasuries, absolutely, causing yields on those treasuries to rise beyond belief, and it's screwing up the debt markets here in the United States, and everybody's wondering why. We'll know why. Right? We'll know why, because it's being exposed right here. Thank you guys for sticking it out as long as we have. We got 16 people still watching. I saw it was up to 20 at one point there. All right. Despite the nascent direct link excuse me. Despite the nascent, how am I supposed to nascent direct linkages in the transmission of financial shocks to date has been experienced through the changes in market sentiment and the repricing of risk. For instance, in August of 2015 and January of 2016, rapid declines in Chinese stock market of 26.7% and 18.8% were felt in the United States, with declines in the S&P 500 over the same period of 7.7% and 8.8% respectively. Recent estimates by the OECD research pain and by this research group of 2022 suggests that a slowdown in China induced by stresses in the property development sector would affect global equity markets, partially over uncertainty surrounding financial conditions and causing a repricing of risk. So you see, like people say, like, what is the harm? Let them, like, again, suggested that a slowdown in China induced by stresses in the property development sector would affect global equity markets, partially over uncertainty surrounding the financial conditions. Right? All of a sudden, interest rates start to move on account of what's happening in China and causing repricing of the risk. The OECD Global Economic Model suggests that the largest financial impact would fall on Japan, followed by the United States, and then the European Union. Perhaps surprisingly, their model suggests that the financial impact for the United States would be higher than the trade and supply shock components. All right. Let me read that again. Perhaps surprisingly, their model suggests that financial impact for the United States would be higher than the trade and supply shock components. Generalized contagion through global financial markets could also impact countries that maintain hubs for financial markets of all types. For instance, London, New York, Singapore, and Hong Kong Special Administrative Region, the SAR, account for 75% of all OTC foreign exchange transactions in 2019. So all these people would be hit. Shocks to Chinese real economy, the world's second largest, could also find their way to a number of advanced and emerging market countries. Japan and Southeast Asia would likely suffer the most given their strong trade and surplus chain links with China. The United States, however, would not be immune, given that China is the largest trading partner, larger than either Mexico or Canada. So this is like, I think that's changed just recently to Mexico now. U.S. imports from China amounted to $435.5 billion in 2020, about 18.6% of total U.S. imports. And these imports are invoiced and financed predominantly in U.S. dollars. Difficulties in obtaining dollar liquidity for Chinese importers could result in supply chain delays and disruptions, including a need for importers to find other suppliers, disrupting consumer goods and other intermediary inputs sourced from China. So again, like the dollar funding right there, it could be creating issues with supply and chain disruptions, right? Let me read that again, because I think that's really important to understand. Like a lot of times as we think about people getting away from the dollar, what that's actually going to do. Difficulties in obtaining dollar liquidity for Chinese importers could result in supply chain delays and disruptions, including a need for importers to find other suppliers, disrupting consumer goods and other intermediate inputs sourced from China. So this is like, I mean, to me, this is really good information and like to try and internalize it. And like I said, a lot of this stuff is really difficult to like actually grasp the first time. That's why I like suggest to people you just kind of read it over and over again until you've like really kind of grabbed a hold of it, what it is that they're trying to say. While there are many motivations for issuing dollar-denominated debt, as noted in Section 2, excessive buildups of dollar funding to Chinese corporations and financial institutions are concerning whenever stressful conditions ensue, right? So it's no big deal until there's stresses, right? Excessive buildups of dollar funding to Chinese corporations and financial institutions are concerning whenever stressful conditions ensue. Recognizing its institutions' large and growing exposure to U.S. dollars, Chinese authorities have taken mitigating measures, but their effectiveness remains unclear, especially in the near term. There are several existing avenues through which China could obtain U.S. dollar funding on short notice. However, the reliability of these avenues is uncertain. So this is how they're going to, this is pretty interesting too, how they talk about it is that these Chinese entities are going to, the Chinese authorities are going to plan on obtaining US dollars when times of stresses, right? Chinese banks are generally required to maintain mostly balanced position of foreign currency denominated assets and liabilities, including off-balance sheet derivative positions. However, even if overall exposures are close to zero, maturity mismatches, whereby short-term dollar liabilities need to be rolled over, are problematic. The new Basel III requirements, specifically the net stable funding ratio, attempt to limit excessive risky maturity mismatches in every currency. Although China has officially implemented these standards to counter excessive mismatch risk, maturity mismatches are an integral part of the typical banking business model. Aside from regulations aimed at domestic banks, Chinese authorities are increasingly restricting debt issuance by non-financial corporations in the property sector and by LGFVs. Let me say that again. Aside from regulations aimed at domestic banks, Chinese authorities are increasingly restricting debt issuance by non-financial corporations in property sectors and by the LGFVs. Lowering overall debt issuance of non-financial corporations and LGFVs could reduce dollar exposures, but only if dollar-denominated debt is reduced proportionately. Regulations now state that new loans are not to be used to roll over existing debt, so liquidity issues may arise before overall debt levels fall to less risky levels. A proposed nationwide property tax on homeownership may help wean local governments from land transfer fees and help reduce the impetus, did I say that right, for LGFVs to ensue debt on behalf of the local governments. However, few countries have accomplished the goal of insulating their non-financial corporations from the risk of foreign currency denominated debt, in part due to incentives to move funding activities abroad to circumvent such rules. See, like, I don't know if you guys caught that right there. Few countries have accomplished the goal of insulating their non-financial corporations from the risk of foreign currency denominated debt, meaning that, although they try to keep them from using dollar denominated debt, it's in in part due to its incentives to move funding activities abroad to circumvent such rules. They just take their funding out elsewhere, right, to find that dollar denominated debt. Nonetheless, Chinese ability to control large portions of its economy may provide it with the tools to do so. An often used measure of countries' ability to withstand liquidity stresses is the quantity of its official foreign exchange reserves, the amount of dollar-denominated reserves held by Chinese State Administration of Foreign Exchange, SAFE, right? An entity within the People's Bank of China, is closely guarded secret. As of the end of August of 2022, SAFE reported total foreign exchange reserves of 3.055 trillion, down from 3.8 trillion in 2013, which is a 4-year low. Still, SAFE has the world's largest foreign exchange reserves, nearly $1.8 trillion more than that of Japan's reserves, the world's second largest. The IMF data shows that in aggregate, 59.2% of all central banks' FX reserves are dollar denominated. Right? 59.2% of all central bank FX reserves are dollar denominated. If this percentage is applied to China, then a rough estimate of 1.8 trillion of US dollar denominated assets would have been available as of August of 2022 as a potential source of liquidity, assuming that in stressful event, SAFE would have been willing to sell or obtain dollar financing from these assets, perhaps through the Fed's FEMA repo facility discussed below, and assuming that the dollar's assets are not already encumbered. You guys sticking with this? How many we got? 13. We got 13 left. Well, that's cool. I know it's boring as hell, but again, let's get through it, right? As another way to estimate Chinese holdings of U.S. dollar bonds, the U.S. Treasury Department, Treasury International Capital, the TIC, system publishes data covering the holdings of various U.S. dollar denominated securities by country, including total holdings of long-term securities, U.S. Treasury agencies, debt, and equities. As of June of 2022, Chinese private and official sector investors, which include SAFE, together held 1.5 trillion of these long-term U.S. securities, of which 0.97 trillion are long-term U.S. treasuries and 244 billion are U.S. agency securities. In principle, if China's banks or corporates were to experience dollar funding stresses, SAFE could sell or finance some of its dollar-denominated assets so the PBOC, the People's Bank of China, could lend the dollar proceeds to Chinese banks, which could in turn lend dollars to firms in China. In the month of March of 2020, the quantity of treasuries owned by foreign official sector owners that were custodied by the Federal Reserve Bank of New York fell by slightly over 100 billion, suggesting that some banks liquidated their treasuries, perhaps in part to alleviate dollar stresses in their banking system. The TIC data shows that China's total holdings of U.S. treasuries declined by only 20 billion between February and April of 2020, indirectly suggesting that SAFE was not much of a source of dollar funding relief, at least via these holdings. Dollar assets are presumably held by Chinese official sector and the banks outside of the United States. So it is possible that China provided dollar liquidity obtained from these other locations. Although funding relief was not apparent in the turmoil of 2020, more recent developments suggest otherwise. Between January and July of 2022, while the renminbi fell against the US dollar by around 6%, which has made it increasingly expensive for Chinese property developers to meet their dollar obligations, China holdings of U.S. treasuries dropped by 98 billion, 9.2%. This might suggest the indirect use of FX reserves. Chinese authorities have also used other tactics to allow banks to provide dollar funding to property developers, including a lowering of the foreign exchange reserve ratios from 9% in May of 2022 to 6% in September of 2022, and managing a slow but steady alteration of the official fixing of the midpoint of the USD CNY fixed range. These actions suggest that some gradual, mostly indirect interventions have been implemented to slow the depreciation of the renminbi and often to blow the property developers and soften renminbi and then soften the blow to property developers without directly parting with the FX reserves. Um, the FX reserves serve other purposes, including the management of exchange rates and the need to pay for imports. In the past, SAFE has been willing to part with foreign exchange reserves for various purposes. In recent years, SAFE has reduced the degree to which it uses its reserves to support the price of the renminbi. The number of months of import coverage is a common benchmark for the FX reserve sufficiency. As of the end of 2021, SAFE reserves covered 13.3 months of China's imports, which could be considered adequate for international standards. On the other hand, relative to broad money M2, SAFE FX reserves are below a generic safety threshold of the IMF. This measure considers how reserves could be used to cover the domestic banking deposit outflows from China, taking into account China's use of capital flow measures, including limitations on capital outflows. The IMF judges the IMF judges its reserves to be adequate. It's far from obvious that China would wish to suddenly liquidate a large amount of dollar-denominated official reserves to cover stressful dollar funding gap in China's banking and corporate sector. A significant rapid sale of dollar assets would cause price impact losses, reducing both proceeds of the sales as well as the mark-to-market valuation of the remaining reserves. Indeed, the lack of functionality of the U.S. Treasury market during the March of 2020, quote, dash for cash, suggests a very real risk that liquidation of U.S. Treasury holdings could be detrimental to large holders' balance sheets. Moreover, the associated reduction in dollar-denominated FX reserves would leave China more exposed to future stresses. So I think if you guys kind of wanted to, that part right there, like as they go to start selling off those treasuries to come up with the funding, the actual sale of treasuries itself would then start causing the value of the treasuries to fall, meaning that their balance sheet would then become less, have less value to it because of that actual sale, right? The significant rapid sale of dollar assets would cause price impact losses, reducing both proceeds of the sales as well as the mark-to-market valuation of the remaining reserves. So they, like, as they go to sell, right, the price that they're selling it for would start to fall because they're flooding the market with it, meaning that the rest of them that they have would start to lose value as well. And that's a bad deal, right? And so this is where the FIMA repo facility. Now, this is a pretty interesting one, right? Because this is like the repo facility that the United States had here, the reverse repo, where, back in September of 2019, when all of a sudden there was like a lack of cash within the banking system itself, the Federal Reserve stepped up and says, hey, you hand us their treasuries that these big banks had a bunch of. You give us the treasuries, we'll give you cash. You can operate the next day, and we'll just kind of reverse this thing and keep doing it over and over again. So, again, here we go. Rather than liquidate U.S. treasuries outright, right, instead of selling those things, when domestic borrowers, including banks, face stressed conditions for the acquisition of dollars, a central bank could potentially obtain dollar financing in exchange for its treasuries through the Fed's new repurchase agreement facility for foreign and international monetary authorities, the FIMA repo facility. Using this facility, a central bank with custodial account at the Federal Reserve Bank of New York can obtain repo financing for securities held in the custodial account. The interest rate for the facility is 25 basis points as of April of 2022, with a pre-counterparty limit of $60 billion. The identities of the account holders are confidential. Access to this facility is in the discretion of the Fed, which has the right to approve or deny requests when they are made. Assuming that the People Bank of China has such an account, it could post its treasuries and agencies as collateral and obtain U.S. dollar funding, which could be on lent to banks in China. It's a very interesting concept to think about, how it is that they don't even have to sell these treasuries. They can hold on to them, just use them as collateral with the Federal Reserve to obtain the funding that they need. So it wouldn't even be a selling of these treasuries. It's just literally like, very much like a lot of these banks were using the repo facility here for. It'd be almost the exact same thing, right? Put those things up for loan to get the dollar funding that they need. To date, the FEMA repo facility, which was established as a temporary facility in March 31st of 2020, before becoming a standing facility on July 27th, 2021, has not been drawn on significantly. Right? So this is kind of important. I think just the idea that it's there is enough, right? In the spring of 2020, the largest the largest use of the FEMA occurred during the week of May 13th with an uptake of $1.4 billion, followed by two other uses in the weeks ending in July 1st of 2020 and September 30th of 2020 of about $1 billion each. This facility did not play a significant dollar funding role during the crucial March and May 2020 period of dollar funding stresses, perhaps because the stresses in the market conditions were already dissipating by the time the FEMA was set up. Nevertheless, the FEMA repo facility potentially can be an effective avenue for providing dollar funding to the PBOC and thus to China's banks during dollar liquidity crunch. Very important to remember, and the reason why I bring that up, and that's probably one of the key things that I actually focused in on, is because it's not used much, but it's an availability to them. So if we ever come into a situation in which that the liquidity issues start to rise, and they wonder what it is that China's going to do, it may be this FEMA repo facility that gets set up that a lot of, not just China, but all nations, like could possibly, not all nations because not all of them have access to it, but significant nations, according to the Federal Reserve anyway, could have access to funding by simply swapping out their treasuries in the same fashion that the big banks here in the United States were doing. All right. How much farther is it? I think we're almost done here, guys. Well, how long are we into this? Wow, we got a couple of super chats going. Thank you very much. We're an hour into it. Okay, I think we can finish this up. All right. Other country swap lines. Another potential avenue for dollar funding is through Chinese banks with affiliates in other countries that have more abundant dollar funding, including through the Fed's central bank swap lines. Central banks with unlimited Fed swap lines, including the ECB and those of Canada, Japan, Switzerland, and the United Kingdom, although Canada has not used the facility. The central banks of these countries would need to accept the credit risk of the Chinese bank affiliates in their jurisdictions if they were to supply dollar funding to them. The short-term debt ratings of the four largest Chinese banks are all P1, P-1, F1 plus, and A1 for Moody's, Fitch, and S&P respectively. We believe that it is natural to view these four giant, mostly state-owned banks as too big to fail, and also to affiliated with the government of China to be allowed to fail, and also to affiliated with the government of China to be allowed to fail, except in the most extreme scenarios. Most central banks of countries that can provide local dollar funding explicitly state that they would only lend swap-related dollars to banks that are licensed in their countries or that have formal accounts with the respective central banks. Several Chinese commercial and wholesale banks have this central bank access, through which dollar funding would be provided. Man, this stuff is confusing as hell, isn't it? I mean, I read through it, and then, like, if I don't understand anything, I just keep going back and reading it over and over again until I finally get it, And a lot of this stuff is confusing. Like, once you kind of get it, then it's probably not that confusing at all. Like, it's just like, oh, well, that kind of makes sense. But a lot of times it's just like, what the hell are they talking about, right? After the Asian crisis of 1998 and the ASEAN 3+ countries, the Chiang Mai initiative provided for a common swap pool. The CMIM, conceptually, this pool is meant to be drawn when any member of the country has insufficient foreign exchange reserves to support its currency or to meet capital outflows. Japan and China are the largest contributors of the FX reserves to the CMIM, with much lower amounts committed by the other Asian three countries. Anyway, the ASEAN three countries. A likely implication is that Japan and China would be the suppliers of liquidity for other countries. The facility has been sized with this in mind at only $240 billion. However, with Japan and China each having much greater U.S. dollar funding needs than other members combined, at this point, it would be difficult for the facility to fulfill its formal mandate to provide reserves for any member country. Indeed, some of the other member countries in the region who would have used the CMIM in March of 2020 preferred to tap the IMF's liquidity facility rather than use the CMIM facility, which has yet to be accessed. Well, it's good to know like some of these things are existing out there, even though they're not really using them. But just understanding that they actually exist is probably pretty important to know, considering, that the liquidity issues are probably coming, and these are going to be quite significant when that happens. All right. As the financial center closes, avenues through Hong Kong SAR. As the financial centers closest to the mainland China, Hong Kong SAR has served as a conduit for financial flows into and out of mainland China. Although the Hong Kong Monetary Authority does not have a dedicated swap line with the Fed, it has facilitated dollar flows between international financial markets and China through its dollar swap facility, and could potentially keep some amount of dollars flowing into China. On July 30th of 2021, the HKMA decided to convert its existing temporary U.S. dollar liquidity facility into a standing arrangement, following the announcement that the Fed converted its temporary FEMA repo facility into a standing agreement on July 28th, 2021. So you can't tell me those two weren't working in conjunction with each other, right? Let me read that again. On July 30th of 2021, the HKMA, the Hong Kong Monetary Authority, decided to convert its existing temporary U.S. dollar liquidity facility, which was temporary, into a standing agreement, following the announcement that the Fed converted its temporary FEMA repo facility into a standing arrangement on July 28th of 2021. The HKMA offers a collateralized dollar liquidity facility of $10 billion to its licensed banks, which includes several mainland Chinese banks at the same terms as the FEMA repo facility. The HKMA maintains the discretion to scale back or deny bids of any of the licensed banks. Wow, so it seems to me that at the same time that the United States was setting up swap lines through that FEMA facility that they say is not really being used, right? Because we just kind of talked about that. But could be used in case of a dollar crunch. The Hong Kong set up one that was very similar to deal with its Chinese banks. Yeah, these guys were working together on that. Yeah, I mean, there's no other way that they would have had those dates so close to like that. The ability to post Chinese bonds as collateral internationally. Here we go. Owners of bond issued by entities in China could, in principle, obtain secured dollar financing by posting those bonds internationally as collateral. Right? So somebody's going to loan out dollars using Chinese bonds as the collateral. Currently, however, international central security depositories do not have arrangements that would allow this. In April of 2021, BNY Mellon announced that its tri-party platform now accepts Chinese bonds as collateral when pledged through Hong Kong's Bond Connect. In a separate report, the CEO of BNY Mellon Government Securities stated that the Chinese bond market is now the second largest in the world, with overseas investors' balances of Chinese assets ever growing, providing a solution supporting assets to be used as collateral within the secondary market is critical in enabling liquidity, enhancing financial stability, and reducing funding risk. Although bonds denominated in the CNY would typically be assigned a substantial haircut, right? So, like if you're using these bonds, you're not going to get nearly as much money using that as collateral as you would like a U.S. Treasury. And that's what that makes sense. Because you got all this risk associated with these Chinese bonds, right? Okay. Although the dollar-denominated CNY would typically be assigned a substantial haircut, an increased ability to pledge China bonds globally would nevertheless open the door to a substantial new potential source of dollar funding for banks, asset managers, and security dealers in China that hold unencumbered high-quality CNY-denominated bonds, such as Chinese government securities. So you can use bonds denominated in Chinese currency as collateral to get the dollar funding that you are needing. However, it's going to take a huge hit, right? You don't get nearly as much putting those up as collateral, but it is a source of being able to get that funding. All right, we're almost done here, guys. This is the last part of it right now. Conclusion. We have documented that Chinese potential needs for U.S. dollar funding during periods of stress are large. China's use of relatively short-term dollar funding has been increasing and seems likely to continue to grow. In March of 2020, the pandemic induced turmoil in global dollar funding markets as reflected in violations of covered interest parties, afflicted a number of countries relying on large dollar rollovers. This dislocation in dollar funding for Chinese financial institutions seems to have been large. Judging from the data that we have presented from the cross-currency basis for the USD-CNY and the USD-CNH. During future periods of stress in the dollar funding markets, China might have difficulty in quickly sourcing a sufficient quantity of dollar financing to control liquidity stresses on its financial institutions and corporate sector, which could lead to a global spillover. After noting some of the solutions that Chinese authorities are attempting to implement to mitigate dollar exposure, we documented some avenues for dollar funding to Chinese entities during stress periods. Among these, the FEMO repo facility, to the extent available to the PBOC, may turn out to be effective in terms of size and immediacy, assuming that the Chinese FX reserves include a large quantity of U.S. government securities that are custodied, I just love that, at the Federal Reserve Bank of New York. FEMA and the central bank swap lines are partial substitutes for each other. Neither is likely to cover all needs, and both offer significant potential dollar funding to central banks facing a dollar funding stress event. In any case, there is a risk of disruption to dollar funding markets arising from the potentially large and sudden need for Chinese banks and corporates to roll over dollar-denominated debts. Absent a means of rapidly and efficiently dealing with these large dollar funding stresses, the adverse impacts on Chinese financial stability and economic growth could be substantial and could spill over the rest of the world. Woo! Okay. That was a little tough to get through. I kind of stuttered through a lot of that. Some of it is still confusing. I need to wrap my head around a lot of it. But ultimately, the idea that the Chinese banks, the Chinese government over there is sitting in a situation in which that the dollar funding stresses could really create some serious havoc that not only will affect them and their country and their economy, but then start spilling out into the rest of the world. it is very important for the Federal Reserve to have a swap line set up, or at least the facility set up to at least mitigate a lot of these stresses to those entities that are in China and with their banks and their corporations, in order for them to roll over their old debt into new debt, or at least be able to find the funding that they need in order to pay their debts. And this is really where it's going to start coming down to, like, I believe in the future, the issues within the dollar and the liquidity of it. Everybody sees all this dollar printing and thinking, man, is this going to totally destroy the world with the amount of dollars they printed? But hardly anybody takes into consideration how much demand for dollars actually exists out there, and whether or not they are actually going to be able to get those dollars they need to pay those debts. All right, let's go check out some of these super chats. Thank you, everybody, for being here. We're about an hour and 15 minutes into this. I really only wanted it to be in about an hour-long video, but, I always make these things longer than than I think. All right, BuzzTune, thank you so much for the $2, man. That's really cool of you. All right, Brothers64, again, thank you for the $5 Canadian. You guys are awesome. All right. Hey, it's great to see you up in here all nighter. We got Dylan. Dylan says, got to get economics down, then property management, then rehabs, then laws, then development. Thanks. Yes, please send me all info that you think's helpful. Dylan, right. Love it, Dylan. All right. I need it all. Deja vu. Of course, the liquidity assets are there, but all they'll need to do is file bankruptcy on our dime, thus no loss of foreign debt. Who do you trust? Interesting. Looking forward to your project playing out. All night a hider, there's a Cash App for UE. I'm not sure he should see this and answer. Did I miss something up there? Screenshots of case law. Thanks. Check them out after Lumberjack's course. Shopping debt. Okay, well, I'm not sure what the I don't know. You guys are all talking there, so I'm missing it. All right. So they're going to sell Bitcoin too to get their US dollars as well. Well, I don't know if, like, the selling off of Bitcoin is actually a strategy to try and acquire dollars that they need in order to continue on with their funding. Really, like, you think about it, China only has a couple of ways that you can really get dollars from, right? You can borrow dollars, you can sell your stuff to get dollars, or you can lend money out there like they did with the Belt and Road Initiative and get those other nations to go and acquire dollars however they do it and send it to them through the loans, like through the debt issuance that they had done with these other nations. But China's in a position in which that, like, acquiring dollars is going to be very difficult if their manufacturing is starting to leave their nation. And this is one of the major concerns that I think a lot of people should have, because if China has difficulties getting dollars in, and they want to be the ones who are issuing out debt to try and acquire, like, like, if you're not sending out stuff to get money in, then you have to borrow the money to get it. So, like, the United States, when we used to be like the manufacturing powerhouse, it was kind of easy for us to get money. We just built a really bunch of awesome stuff and sent it out there to the rest of the world. Well, as the rest of the world started manufacturing stuff too and wanted to sending it to us, we were going to end up losing all our money, right? Sending all the gold back out there. So we just started issuing out debt instead. Now, China wants that position, right? Who would love to have that position of being the debt issuer, but you have to have the trust of China. And nobody trusts China, not enough to, pay back all their debts like, the United States Treasury will pay. I just turned 18 2-ish months ago. I want 50 units before a year of my first property. I want 50 units before a year of my first property. Then I want to get enough credibility to teach others how to do it, do what I did, and help others be financially healthy. Well, there you go, Dylan. Physically and mentally healthy. Dude, you're right on the right path, man. I mean, I wish I had your kind of ambition when I was your age, because even now, like, the idea of a 50 unit apartment complex or something, like it almost seems overwhelming to me. I was just like, man, do I really want to get into that kind of effort and stuff? Like if I was younger, I'd totally be onto it. But now it's just like, I mean, I'm not that old, so it wouldn't, it'd be kind of cool. But like that seems so ambitious to me right now. And not like out of the realms of possibility. It just seems so much. And at 18, man, to have that kind of ambition, hell yeah, dude. I mean, absolutely go for it. The chat has spoken. We want UE Lumberjack collab live stream. Yeah, we can do that. I'll get a hold of Matthew and we can do a live stream. Let's set one up. Let me see. What am I doing next weekend? I got a birthday party to go on to Saturday, but I could probably do something Sunday. So I'll get a hold of him and see if he wants to do a collab on his channel or something. You got a whole family. I don't have any risks. Alrighty, guys. This was a lot of fun, but I gotta go take the family to. What are we going to do today? We're going to go out to Fort Stevens. I'm going to let Mac drive around the big parking lots over there. He wants to, drive around in the car. So he's getting used to knowing what it's like to sit behind the wheel. He's a little nervous about it, but I think he's doing pretty good. So that's probably what we have planned for the day. And I don't know what else. We'll figure it out. But anyway, uneducated economist, guys, you let me know.